Assalamualaikum and a very good morning. My name is IKRAM SHAFI'I, and today we would like to take this opportunity to present on our case study on Telekom Malaysia Berhad, or better known as TM. Before I proceed with the first question, I would like to present a little bit background of the company itself. Telekom Malaysia Berhad, TM, was first established as the Telecommunications Department of Malaysia in 1946. Since its humble beginnings, the group has grown into an institution on its journey of elevating the nation's telecommunication infrastructure, technology and services. TM is a Malaysian-based company which provides communication services. The company's principal activities include the establishment, maintenance, and provision of telecommunications and related services. The company segments include mass market, comprises the company's retail arm and its subsidiaries, which complement the retail business. And it also manages accounts, responsible for the provision of range telecommunication services and communication solutions to small and medium businesses. Since its establishment, TM has been receiving many awards and recognitions for its achievements. Among others are Best Telecommunication Service Provider in 2018, Malaysia Best Employer Brand Awareness 2018, and Malaysia Best Brand Awards 2018. And for the purpose of this assignment, most data and information are obtained from the company's annual report as at 29 March 2019. Okay, for the first question on the stockholder analysis, breakdown of the stockholders in the firm, either individual, institutional. Okay, for the first question, it is found that Telekom Malaysia has open share to public, individual, and for institutional. This shown Telekom Malaysia analysis of shareholding as at 29 March 2019 are as below. It issues shares of 3,757,934,824 ringgit. As at 29 March 2019, the issued shares of TM was 3.7 billion, and the number of shareholders are 37,637. For each ordinary share carries one voting rights. As reported on the same date, the highest number of shareholdings held by Malaysian with 36,570 shareholders, while the remaining shares are held by foreign with 1,119 shareholders. Given that foreign shareholders hold only 2.97% of the total shares, hence, it does not give a significant impact to the company if the foreign shares are disposed in the market. So, the top 10 shareholders of TM are Khazanah Nasional Berhad, which has 26.21% issued shares. Number 2 is Citigroup nominees. 3 Amanah Raya. 4 Kumpulan Wang Persaraan Diperbadankan. 5 Amanah Raya Trustees Berhad. 6 Amanah Raya Trustee Berhad, Amanah Saham Malaysia. 7 Amanah Raya Trustee Berhad, Amanah Saham Malaysia 3. 8 Value Cap Sdn Berhad. 9 Amanah Raya Trustee Berhad, Amanah Saham Bumi Putra 3 Didik. And lastly, Urus Harta Jemaah Sdn Berhad, which consists of 1.08% of total share. And the top 10 individual shareholders in TM are Board of Directors members, consists of Rosliman and Balasinggam A. Namasiwayam, and the total shares are 16.013% shares. The analysis showed that most of TM's shareholders are from companies. The top 30 companies have total number of shares of 79.98%. The highest shareholder is Khazanah Nasional Berhad with 26.21% shares. Thus, they have the majority vote towards the company decision. Distribution of ordinary shares as at 29 March 2019 are as below. The TM's top 10 shareholders are as below. The top 10 individual shareholders in TM are Board of Directors members.
Assalamualaikum, my name is Muhammad KHAIRIZAL. I will be presenting question number 2, okay, regarding risk and return. Okay, so Telekom Malaysia OTM has a beta of 1.777. Data was extracted from shareinvestors.com. Okay, regarding the beta, from my analysis, I use 500 days of beta to see company volatility for last year performance. Company has a beta that is higher than 1, means it is more volatile than whole market. With beta of 1.77, it is assumed 78% more volatile than the market. Okay, all data extracted for calculation are based on 2018 as equal to data taken for further analysis in TM Annual Report 2018. Okay. The value of a risk-free rate of return is obtained from Bank Negara Malaysia website, in which Malaysia government securities represents the risk-free rate of return. The risk-free rate is equals to 3.447% as at November 2018. Meanwhile, the value of implied market return or ICOC of Bursa Malaysia, okay, from KLIC is obtained from www.marketriskpremia.com, which is equals to 7.32%. The value of ICOC that is updated until December 2018. Okay, the cost of equity can be shown as follows. The cost of debt can be shown as follows. And lastly, the WACC can be shown as follows. Telekom Malaysia Berhad has debt ratio higher than equity ratio. It shows that it has more debt financing than equity financing. Based on the calculated ratio of debt and equity, the cost of equity for Axiata is riskier with respect to its debt. The cost of capital is appropriate hurdle rate when returns are measured to all investors in the firm. Thus, a new acquisition will have to earn a return on all capital invested of greater than 5.7% to be considered as a good investment.
Hi, Assalamualaikum. My name is Muhammad SYAZWAN bin MAZMADI. So, for my question is number 3, is investment return. Is there any project for the firm? So basically, so in beginning of 2020, so basically Telekom will participate in a 5G demonstration project in Malaysian Communication of Multimedia Commissions to roll out its first 5G standalone network in Malaysia. So basically the deployment of the tested and proven 5G enables the smart solutions for the showcase in some places is a testament to their commitment in accelerating the delivery of 5G services nationwide. So I believe that by implementing this project, they will definitely grow bigger, they will grow higher in 2030 as one of the most high growth of the telecommunication in Malaysia. So basically there are also some of the projects. So TM1 is their subsidiaries. They are also further demonstrated its capability to enable digital businesses and government with smart solution and end-to-end hyper-connected ecosystem. TM as a national telecommunication infrastructure provider continues to serve as the industry backbone, serving and collaborating with all other licensed operators in Asia and the strategic enabler of the government's national fiberization and connectivity, which is called NFCP, towards reaching more underserved areas nationwide and supporting the 5G requirements with its ready and upgraded network infrastructure. So basically, NFCP, the National Fiberization and Connectivity Plan, was formulated in response to the nation's desire to improve broadband quality and coverage and reduce broadband prices and provide internet access across all spectrums of society. The communication infrastructure, in particular fiber network, is needed to support the digital economy agenda, enabling all the Malaysians to harness opportunity. So basically, TM is one of the backbone of the telecommunication in Malaysia. So basically they provide a high-speed fiber optic network that will provide a lot of overall benefits for consumers, businesses and civil service. It will also provide a positive impact on the environment as more and more people will stay home and result of a line transaction. So basically, what will happen in the long term, the impact of the implementation will attract a lot of new businesses and increase employment opportunities, especially in the rural areas, besides reducing urban migration. So basically, when doing this, they will definitely reduce the migrations of the urban people, and therefore they will increase their profit and revenues. The implementations of a comprehensive broadband impact positively the nation's GDP growth. Broadband utilities are essential for the growth of the nation's economy. A 10 percentage point increase in the fixed broadband penetrations would increase the GDP growth by 1.2% in developed economies and 1.38% in developing ones. Hence, Malaysia, the GDP growth of 1.38% is estimated at RM 17.9 billion, which is USD 4.2 billion. One of the projects that has been made by Telekom Malaysia Berhad is also is a public sector businesses solutions arm, TM1, a local property developer, which they have done a Bintang Urus Juta Sdn Bhd launch, their first digital home project located in Melaka. So basically, the development is the first. So basically, what they are doing is that the development is the first housing project in Melaka that is ready with various digital home solutions at the same event. So basically, TM1 and Bintang Urus Juta also signed a memorandum of agreement (MOA) for the appointment of TM1 as a strategic partner for the development of digital home solutions, which enables homeowners to enjoy a high-speed internet access along with other digital services such as unified TV, digital home hub, security, warning system, smart plug, and sensor movement through its dedicated digital. So in the long term, for this project to succeed, the establishment of the home digital in Melaka is in line with the intentions of the state government of Melaka as a smart city by 2030. TM is also allocating 18 to 20% of its revenue for capital expenditure to drive connectivity and digital expansion. The year is also set to be another challenging year for TM, as the revenue project to decline to low to mid single digit after declining 2.2% to RM 11.82 billion in the financial year 2018 from 12.08 billion previously. So the company's net profit of the year also fell sharply to RM 153.15 million from 929.75 million in 2017, while the EBIT grew within guidance at RM 1.7 billion. Thank you.
Okay, for question number 4 regarding capital structure, based on TM statement of financial position, the data is shown as follows. Next, the debt equity ratio is shown as follows. And the total equity ratio is shown as follows. Telekom Malaysia has debt ratio higher than equity ratio. It shows that it has more debt financing than equity financing. However, company balance sheet registered positive performance in terms of balance sheet when it shows net current asset amounting to 1.2 billion ringgit Malaysia. Advantages of debt over equity financing. First, utilization of resources. When a business use debt to finance its operation, they got no option than to fully utilize their resources because they will have to pay back the debt and interest to their creditor. Second, short-term needs. Debt finance can easily be secured on a short-term basis. This makes it very advantageous to small businesses as finance of the start can be easily be secured for short-term business needs. Third, tax advantages. Debt financing also offers tax advantage to business as interest is deductible for income tax purposes. Number 4, no future lender claims. Lenders has no direct claims on future earnings. Number 5, not dilutive. Debt does not dilute the ownership of your small businesses. 6, simple loan repayment. Lenders are only entitled to loan repayment and interest on loan. And lastly, number 7, future impact forecasting. interest and principal repayment are based on fixed percentage and can be forecast. Next, the disadvantages of debt over equity financing. First, the main disadvantage of this type of financing is that it requires a business to make regular monthly payments of principal and interest. Because of shortage of cash flow, it is usually difficult to make regular payments off to creditors. Second, most lenders provide severe penalties to late or missed payments, which may include charging late fees, taking possession of collateral, or calling the loan due early. Number 3, failure to make payments on loan, even temporarily, can adversely affect a business credit rating and its ability to obtain future financing. Fourth, another disadvantages associated with debt financing is that the availability is often limited to established businesses. Since lenders primarily seek security for their fund, it can be difficult for unproven businesses to obtain loans. And lastly, the amount of money small businesses may be able to obtain via debt is likely to be limited, so they may need to use other source of financing as well. That's all. Thank you.
Assalamualaikum. My name is Muhammad Arif bin Jalil. So I will answer the question number 5. So question, how has this firm returned cash to its owner? So has it paid dividend or has it bought back the stock? So based on dividend policy proposed by TM, so the TM said that based on the dividend policy, so our company intend to distribute yearly dividends of 700 million or up to 90% of our normalized PATAMI. So PATAMI is actually profit after tax and minor interest, so whichever is higher than 90%. So as you can see from the dividend per share on 2014 until 2018, the dividend fulfill the company dividend policy with average of 90% more than the dividend payment of 700 million. But in the 2018, the dividend per share decreases as the TM was massively in great loss. So the next question is, assuming that this firm has excessive cash and given its characteristic, how would you recommend that they return cash to the stockholders? So this I get from the TM official website. So they said that dividend will only pay if approved by our boards of funds available for such distribution. So the actual amount and the timing of dividend payment will depends upon our level of cash and retained earning, result of operations, business prospect, monetization of non-core assets, project level of capital expenditure, and others investment plan, current and expected obligation, and such other matters as our board may deem relevant. So the next question is how much cash did the firm return to the stockholders over a few years? So the accumulation of from 5 years of firm, they have returned dividend almost 4 billion ringgit to the stockholders. So the next question is how much the cash has the firm accumulated over time. So based on the data, the firm has accumulated with the amount of 346 millions of 5 years time. So the next question is, do you think that amount is sufficient? How much it should return to the stockholders, given that this dividend policy of this firm and its current cash balance? Would you encourage the firm change its dividend policies? So the suggestion to the firm to change the dividend policy is to give the investor a primary dividend to the stockholders of 40 to 60% instead of giving to the dividend of 90%. So after the 40 to 96 to 60% of dividend given to the stockholders for the deposit of their dividend, the remaining income of the company can be cushions to the company, or the maintenance fee, it can be returned to the investor according to the board directors' decision using the special dividend for the stockholders. So this dividend policy will put Telekom Malaysia in much safer zone while create more profit and not loss, and continue to increase the stockholder wealth in the future. Okay, that's all from the question 5.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi taala wabarakatuh, and a very good day. My name is ZCMA6032 bin Muhammad, and I will be explaining the question number 6 and number 7. So let us start with question number 6. Valuation. What is the growth pattern of this firm? How long do you think this growth pattern will last? What are the key drivers of this growth, and what is the market value of the equity in this firm? So when we look at the equation, we have found out that the required rate of return for Telekom Malaysia is negative 17.4%. The negative 17.4% expected growth will last for 5 years. This is supported with the TM performance. Number 1, Telekom Malaysia Berhad TM at the end of 2018 has declined with 83.52% to 153 million from 929 million in fiscal year of 2017. The revenue also fell to 11.82 billion in fiscal year from 12.08 billion previously. In the filing with Bursa Malaysia, TM attributed the performance to impairment of network assets recognized by the group in the third quarter of 2018, which led to a 65.9% decrease in operating profit before finance to Ringgit Malaysia 375.5 million from Ringgit Malaysia 1.1 billion previously. For the fourth quarter ended December 31st, 2018, that is from the fourth quarter of 2018, net profit declined to Ringgit Malaysia 69.66 million from Ringgit Malaysia 277.01 million in the fourth quarter of 2017. In a separate statement, TM said its performance was impacted by persistent headwinds in the industry of operating landscape during the financial year. Total capital expenditure or CapEx for financial year 2018 stood at Ringgit Malaysia 2.14 billion or 18.1% of revenue, lower than TM's full year CapEx guidance of between 90 and 20% of revenue. Meanwhile, TM also declared an interim cash dividend of 2 cents per share, a payout amount to Ringgit Malaysia 75.1 million expected to be disputed on April 12, 2019. For the market value of the equity in this firm, we have found out that it is come out to Ringgit Malaysia 14. We shall continue to question number 7. Perform an analysis on the firm's financial position with respect to these 4 categories of ratios. Number 1, profitability ratios. Number 2, liquidity ratios. Number 3, leverage ratios. And lastly, asset management ratios. The table provided shows that Telekom Malaysia financial analysis for year 2018 and 2017. Based on the table shows for profit margin on sales ratio for current year is 0.13% compared to last year, which is 0.77%. The net income earned with each dollar of sales generated is lower than last year. This shows that management needs to budget and cut expenses. Basic earning power for current year is 0.27%, while return on total asset is 2%. It is assumed that 4% of company's revenue is expensed out as interest expense and taxes. Return on equity for current year 2%, a bit lower compared to previous year, yet still generates profit for shareholders. Current ratio for year 2018 is 1.23 compared to last year, which is slightly lower, 0.98. It shows that the company can pay off 123% of the current liabilities using its current assets. Quick or acid test ratio for current year is 1.21 compared to previous year 0.64. The company can pay off 121% of its current liabilities using its quick assets, but in a worst case scenario, needs to sell long-term assets for the remainder of current liabilities. Debt to equity ratio for current year is 2.22, slightly higher compared to previous year, which is 2.16. This ratio shows that it is risky since the company is leveraging amount of debts funded by creditors than investors. Inventory turnover ratio for current year is 87.81, which is higher than previous year, 46.75. But it is still high, which means that the company does not overspend by buying too much inventory and waste resources by storing non-sellable inventory. Total asset turnover ratio is 0.5, which is higher than the previous year, that is 0.48. It shows that the company efficiency on generating sales using its assets has increased. Overall, the profitability ratio indicates that in year 2018, the company is not generates profits from its shareholders, albeit lower than previous year. It can pay off almost all of its current liabilities using its current assets if needed. More than half current liabilities using its current assets. Its inventories are being effectively sold with increased revenues coming from assets. Its only drawback is that the company's financing comes more from creditors than investors, which is caused by the company's expansions. With that, I thank you.